Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. The Australian dollar experienced losses against the US dollar, breaking through the support level of 66.3545 on Wednesday after the release of the minutes from the US Federal Reserve's May meeting triggered off some concerns that the fact that the Fed is still somewhat hawkish. However, traders, I feel, reacted nervously as the central bank expressed concerns about high inflation, hinting that the interest rate cuts may not happen soon. However, as mentioned, the reaction may be exaggerated as the meeting occurred before the release of the recent colder-than-expected jobs and inflation data. Furthermore, Federal Reserve Jerome Powell reiterated in his May 1st press conference that he anticipates the next move on rates being lower rather than higher. Looking at the technicals, with the market taking out the level of 66.3545, the base is now coming in around 65.80, which anticipates demand. Keeping an eye on this engulfing candle, along with that with 65.80 holding, I do anticipate a potential recovery and looking back towards the region of 66.5 and on towards that key level, which is still there at 67.4045, and reassess. So from the data of the US minutes, the euro dollar also took significant losses, but still finding good support close to the level of 107.6080. And from there, I feel the market, if reached, could rebound to a further aggressive bullish bias and therefore look up towards, and the call still holding at 109 to 110. And with the uptrend helping here, the support at 107.6080 should come in demand when it comes to a challenge to the bullish side. The grind higher for dollar yen continues, but not breaking that level so far, which is seen at 156.80. Nevertheless, if the market does reject this level, I feel that we could be looking back towards 155.80 or even further to the downside, that is to 154.60-65, and reassess from there. A break above 156.80 leaves no view to the top side. A whipsaw price action when it comes to sterling after the UK CPI numbers come in lower than anticipated. April's UK consumer inflation, or CPI data, indicated a year-on-year increase of 2.3% and month-on-month of 0.3%. While these figures mark a significant decline from March reading of 3.2 and 0.6 respectively, they did exceed expectations. And with this data in mind, optimism about a potential June rate cut by the Bank of England is seen at 50-50. Any pullback is anticipated to be short-term, as the support still holds around that 126.40-80 area, and a break above the level of 127.80-90 should ignite the move, and on towards potentially of 130 to 131. From the weekly bias and also from the daily bias, we are a little bit overbought when it comes to the dailies, but the weeklies are still relatively firm and could see this price pattern expand into a bigger bull run. Spot gold, well, the market fell $50 overnight, or 50 points, and crushes the level of 2,390, and now exposes the next target, which is seen at 2,360.75. I feel further weakness may be seen if that level is broken and look down towards the level of 2,250.80, where I've marked here in red. From the long-legged doji and the rejection and the heavy candle from overnight, keep an eye on that level of 2,360, because we are very close to it, and if it's breached, then the bears are likely to become in greater numbers, sending the market lower, as I mentioned, towards this bottom side of the range, around 2,250. Wrapping up with oil, for the downside call, which was around 76.40.55, was near enough reached, and from the given technicals, still remains somewhat negative. If this level breaks, that is at 76.40, the next target is where the measured move from this head and shoulders, where I outline here, and the neckline gives us a move down towards either of 72.65 to about 73.5. Well, that's a wrap. Thank you for joining me. As always, look out for the interest rate report, and I hope you enjoyed the great start to the day.